and it's 1:30 p.m. So it's time to get update from the world of business. Welcome to Business Incorporated. Here's what we have for you on the program today. A bit of relief for Ethiopia there as China allows that country to suspend debt payment in 2023-2024. We'll take a look at Zimbabwe economy as they await election results. And Kenya's Tier 1 banks record currency gains worth 14.5 billion shillings. Good afternoon. Welcome to Business Incorporated, the final one for the week. I'm Ini John Mekwa. We head straight into the markets to see how that's doing at intraday, beginning with what's going on in Nigeria. We see that a recovery giving us a little bit of relief there for the NGX at 0.05%, still on 65,435.55. South Africa is also positive 0.20% at 74,448.69. We look at other regions now. Remember, today is Friday, so we have some of those markets closed. Egypt, for instance, is not trading on Friday, 0.41%. In the green, that's what it closed with yesterday. Kenya has Thursday's figure at minus 0.58%. Of course, losing that 100 index point that has been its resistance for a while. From there, we move over to the Middle East to see how that market is looking at this time. Also in this market, two of them are closed on Fridays. So we have Abu Dhabi intraday 0.02% in the red, as well as Dubai 0.29%. The other markets, Saudi Arabia and Qatar, closed for today, but they closed positive 0.34% and 0.31%. From there, let's head to Europe now, where we have Lars standing by to bring us up to date on one of the latest issues around that country. And the war that's going on in Ukraine is not far away from what's on site, especially with the BRICS summit just ended in South Africa. The Western countries have been wondering how Russia's economy seems to be thriving in spite of the sanctions. And so they've been taking a closer look at that. Lars Halter joins us now. Lars, good afternoon. So, we know the ruble weakened at a point and then regained and saw some new strategies from Russia. But how is the economy doing at this time?
Yeah, thanks for having me. Get ready to be surprised. Russia is doing quite a lot better than we have thought, at least according to some numbers that have come out. The Russian Federal Bank says the economy will be growing between 1.5% and 2.5% this year. And even the International Monetary Fund says Russia will likely see stronger growth than many Western states, including Germany. According to Russia's Statistics Office, unemployment in the country has dropped to 3.3%. Real wages are up, and so is the industrial production for the first half of the year.
Good, better than some countries that are not at war. So that means the sanctions are not working?
Not really, and that's not just because we cannot 100% trust those numbers. After all, these are numbers that came from the government in Moscow, or at least they were given out by some government-friendly sources. But they might actually be very close to the truth. But here's the catch. Even if those numbers were true, they're not showing a sustainable development. For once, they're building on last year's numbers, which were obviously disastrous as the war started and initial sanctions hit. Then looking at unemployment, for example, of course, with many adult males fighting Putin's war, companies all over Russia are desperately looking for workers, so there are definitely enough jobs to go around. And that is also the reason why wages would be up. There are more jobs than people right now, and wages have risen as companies try to hire the people they need. As for the industrial production, the strength in the sector is likely confined to the military sector. As for the rest of the industry, the sector there is struggling, and that is due to some very general problems Russia's economy has always had. The country is extremely dependent on resources, oil, gas, coal and others, and has never diversified or developed to the degree that many other countries have. Russia's industry is mostly lagging behind international competitors, and it needs supplies urgently. They need machines, and not only the kind of high-tech apparatus or chips or so. No, the industry in Russia needs even simple machines to keep up its regular manufacturing businesses. And those machines and other supplies are no longer available due to sanctions. So we will see large parts of the industry falling behind even further.
All right, but what does all this mean for countries connected to Russia and the markets?
Well, other countries have to figure out how they want to deal with Russia in future, as in once the war is over, once there was a change in leadership, and once Russia is willing and able to come back to the table. It will take a long time for sure, and right now there are obviously no signs at all that such a process is even in the cards. While some countries, including China and India, as well as some African nations, might be willing to deal with Vladimir Putin, pretty much the entire Western world won't. Putin, that seems clear, must go, but even then, Russia will have to make new deals to sell its resources. It has to do so as some of its earlier customers have secured new supplies or even changed their strategy and the demand in general. Look at Germany, for example. The government in Berlin has secured enough natural gas to do without Russia now, and is also investing more strongly in alternative energy, taking this more seriously than ever before. Now, it's absolutely clear that Germany will never want to get in a position where they depend on Moscow as a trading partner, because Russia will not be seen as a reliable partner for decades to come. So Russia will need a larger reform of its entire economic system, and governments and markets in other countries will be watching every step of the way.
Yeah, they'll be watching and making decisions too. Thank you so much, Lars, and have a great weekend. All right, now let's go to the United States, where stock futures rose on Friday as Wall Street looked toward Federal Reserve Chairman Jerome Powell's Jackson Hole speech. Futures tied to the Dow Jones Industrial Average ticked up 105 points. Looking at the numbers right behind me there, that's 0.30%, 105 points. S&P 500 is also in the green, 0.28% at 4,398.50. NASDAQ being kind of quiet, not very dramatic this day, 0.14% in the green also at 14,885.50. Well, let's see Thursday's trading, how it ended. Maria Bird has the details.
The U.S. stock market reversed on Thursday as the Dow Jones was down by almost 1%. The S&P 500 sank at 1.35% down, and the heavy tech NASDAQ nosedived at 1.9% down. Even though AI, artificial intelligence, seems to be keeping up and having strong earnings, companies like Nvidia had another great day of earnings. It was not enough to overcome the downturn of the U.S. stock market, as many investors are a bit concerned about the comments from the Federal Reserve, which is stating that interest rates are going to remain high for the near future. This has many concerned about the future of the U.S. economy.
Expected from the United States as well as other countries. Let's go to Asia now, where markets experienced a broad decline as investors braced themselves for crucial insight into the U.S. monetary policy from central bankers. The Nikkei 225, there you have it, is in the green, more than 2% at 13,622.28. The Kospi is also in the red, 0.60% at 2,520.81. The Hang Seng Index is 0.51%, but also in the red. Let's see other markets in the region. Shanghai is unmoved, but it's a negative sentiment there at the close of trade. In Australia, it's a very negative one, 0.89% at the close of trade. Oil prices now headed for a second week of declines, even as it rose on Friday as the dollar firmed before a speech of the Federal Reserve Chair Jerome Powell, while concerns over tight supply eased. Brent crude rose 39 cents to $83.75 a barrel, while U.S. West Texas Intermediate crude was up 39 cents at $79.44 a barrel. For the week, crude prices are set to fall between 1.2% and 2.2%, a second consecutive week of decline. Investor caution ahead of Powell's remarks at the Jackson Hole Symposium lifted the safe haven dollar to a 10-week high, and it's the biggest rise in a month as markets wait for a word on how long rates could stay elevated. On the supply side, talks between Turkey and Iraq's semi-autonomous Kurdistan regional government on northern Iraqi crude oil exports are still going on after officials failed to reach an agreement to restart oil exports earlier this week. Turkey stopped Iraqi oil flows via the Ceyhan port on March the 25th after losing a long-standing arbitration case brought by Iraq. The market is closely monitoring the flows of Iranian oil as the country's crude oil output will reach 3 million barrels a day by the end of September. Iran's oil minister was quoted as saying by the state media, even though U.S. sanctions remain in place. Further weighing on market sentiment, U.S. officials are drafting a proposal that would ease sanctions on Venezuela's oil sector, allowing more companies and countries to import its crude oil. Norway's Equinor said on Friday that it has started production at its extended Staff Jord field 6 months ahead of schedule and expects output to rise by 26 million barrels of oil equivalent. Another commodity now, it's gold. It eased as U.S. dollar jumped spotlight on Powell's speech. Spot gold experienced a marginal 0.2% easing, resting at $1,913.90 per ounce, while its U.S. counterpart, gold futures, exhibited a 0.3% decline, settling at $1,942. The trajectory of gold this week has been noteworthy, boasting an approximate 1.3% climb, potentially marking its first week of gains in this month. And analysts are gauging the recent surge in bond market yields, suggesting a strong possibility that further interest rate hikes might not be necessary. In the words of one analyst, the false break of 1,900 has provided a nice rally to the 1,920 area. But Powell has the ability to send gold back to 1,900. And back here in Nigeria this morning, during Business Morning, we had the Statistician General as a guest. He's been defending the use of the new methodology by the NBS in labor survey. The numbers which show that unemployment in the country has dropped to 4.1% in the first quarter of this year has been raising a lot of questions.
About 95% of people that are working in Nigeria are working in informal sector. So if you concentrate only on those that are working 40 hours that are maybe government workers or a standard company worker, and they are just about 13% of the total workforce, total working age population in the country. So if you want to concentrate on that, and you have self-employed people that work in the informal sector that are like 90%. You want to leave those ones outside and concentrate and say that because what they are earning cannot take them home. But just to show you that this data now reflect exactly what is happening in the economy as a whole. You have people that are in the university, professors that are 70 years of age. In the whole methodology, it means that those people are not going to be considered at all when we are estimating people that are employed in the country. And they are contributing a lot to our economy. We have expanded this to ensure that all the people that are contributing to the economy, all the people that are engaged in one activity or the other are captured.
That was earlier today, and I do believe that is going to raise a whole lot of questions in the nearest future. Let's take a break now on Business Incorporated. When we come back, other parts of Africa are calling for attention. We'll head there. Welcome back. Still watching Business Incorporated here on Channels Television. Let's head to Zimbabwe. It is obviously the news now because on Wednesday, Zimbabweans took to the polls, and Thursday, it had to be extended to Thursday, with some economic concerns and expectations for, one, there's inflation that has gone from single digits in 2017 to 77% this month. In 2023, the currency has crashed against the US dollar, and high unemployment has led many to emigrate. But their worries have become even weightier with an election that has recorded the arrest of 41 local monitors of the country's election, as the opposition has cried foul over irregularities in a poll forced by delays to stretch into an unprecedented second day. What does this mean for the country, for the economy, for Zimbabweans? We have Matt Kindiga now joining us for that. Hi, Matt. Good afternoon.
Hi, good afternoon. Thanks for having me on the show today.
Yeah, so as I said there, the election, the voting itself had to be stretched to the next day. And then with this issue of election monitors being arrested, what do you see at front of you? What's your expectation from the election?
So it's difficult to tell at the moment, but as you've mentioned, the initial reports are not necessarily very promising in terms of allegations of corruption and vote rigging. We doubt that ZANU-PF, the ruling party in Zimbabwe, will sort of easily concede defeat, and we are quite concerned about the outlook for social unrest, especially if there are delays to the outcome to the election. So if the results are delayed very significantly, we could see some social unrest. We don't think there's likely to be a change in regime, and these elections are likely to be viewed as not very free and fair, and the new government won't have as much legitimacy as it would like. So we're not terribly optimistic in terms of the prospects for change in government in Zimbabwe at the moment.
So are they, with all of this and the possible results and these red signs that we see, is there a prospect of Zimbabwe accessing loan funding, World Bank, IMF, any of them?
Yeah, so this is a big question because, it will be very difficult if ZANU-PF has returned to power, as we expect, it will be very difficult for Zimbabwe to once again tap international capital markets. Zimbabwe has been blocked from international capital markets since at least 2000, so 23 years. When it defaulted on its external debts, it has an estimated $18 billion worth of external debts. We don't think this, the IMF or the World Bank will be particularly forthcoming because we would need to see free and fair elections or evidence that elections were free and fair and a new government comes to power legitimately through the electoral process before there is engagement again between the IMF, World Bank and Zimbabwe. The reason why this is so important is that Zimbabwe desperately needs funding to clear its external debts, but also fund infrastructure investment, stabilize the currency, invest in social services. There are a few things that have happened recently. So, for example, in June, there was a $400 million Afreximbank facility that was announced that will provide some stability, but the scale of the external funding required to stabilize the currency, help to tame inflation, and raise investor confidence in Zimbabwe would require, external engagement with the IMF and the World Bank, but we don't think that will be forthcoming.
Yeah, it looks like they actually need a very fast and drastic change, having inflation at over 77%, and the currency crashing. And I think at some points, citizens were using the US dollar instead of the Zimbabwean dollar. I wonder, what do you see all of this amounting to for the Zimbabwean economy?
Yes, so unfortunately, as you mentioned, there was dollarization of the economy in the past. or sort of US dollarization of the economy. We're now in hyperinflationary territory again, so the currency is really struggling and it's in free fall in Zimbabwe. Inflation is well in trillion double digits. Purchasing power of consumers and households is very weak. So the outlook for the Zimbabwean economy is not great. And, as I mentioned, we do need to see some very significant foreign direct investment and structural adjustment funding made available for the country, but that's not going to be forthcoming. And the outlook for the economy, whether or not the country will be able to end hyperinflation, will depend very heavily on the outcome of the election. And if there is social unrest, commercially disruptive social unrest, this won't be good for the economy. However, having said all of this, there are two sectors which are likely to do quite well in Zimbabwe. So we have seen a bumper harvest, especially wheat in Zimbabwe in recent years. And the mining industry is set to grow relatively well because of lots of Chinese investment into lithium mines. So there are a couple of industries doing relatively well, but most Zimbabweans are unlikely to see significant improvements in standards of living. If anything, we could see things get a little bit more difficult as inflation remains extremely high and public services are very stretched. So we are not terribly optimistic in terms of the outlook for Zimbabwe's economic growth, although there will be a couple of industries that are likely to perform better than the economy overall.
Yeah, well, when you mentioned wheat, I think my ears just went up there because with what's going on between Ukraine and Russia, wheat is now like gold, especially in Africa. Well, thank you so much for sharing your perspective with us. Practice leader, Sub-Saharan Africa with Front of You, Matt Kendiga.
Thanks very much.
All right, now China will allow Ethiopia to suspend payments on debt maturing in the 2023-2024 fiscal year under a framework set up by the group of 20 economies. Ethiopian Prime Minister said this during a meeting. He said in early 2021, Ethiopia requested a debt rework under the G20's common framework, a debt restructuring initiative designed to help low-income countries get back on their feet. Progress was complicated by a 2-year war in the northern Tigray region that ended last November. China has committed to lending $13.7 billion to Ethiopia since year 2000, but it was not immediately clear how much of the debt was maturing in 2023-2024, July the 8th to July the 7th fiscal year. Mr. Abiy and China's Xi Jinping met in South Africa on the sidelines of the BRICS summit of leading developing countries. Ethiopia was invited to join the bloc on Thursday, and Ethiopia has a $1 billion international US bond known as Eurobond maturing in December 2024. Earlier this year, an informal group of international bondholders proposed extending the bond's maturity to Ethiopia's government, which did not publicly respond to the suggestion. Kenya's Tier 1 banks recorded currency gains worth 14.5 billion shillings, that's about $100 million, in the first half of the year due to the shilling's depreciation against the local currencies of regional subsidiaries, boosting the value of their earnings, dividends and assets. This was a nearly four-fold rise compared to the gains worth $3.96 billion, that's about billion shillings, that's about $27 million. Reported in the first half of last year. Regional subsidiaries normally prepare their financials in their home currencies, functional currency that is, but when the financials are amalgamated into the group, the currency is translated into shillings reporting currency. This means that there are exchange losses or gains factored in depending on whether the shilling has strengthened or weakened against the respective operating currency of the subsidiary. That's it on Business Incorporated. Thank you so much for being a part of it all through the week. Another round begins on Monday. Do join us then. I'm Ini John McWadu. Have a great weekend.